Good afternoon, everyone, and welcome to the fourth Investing in Germany online roundtable hosted by Refire and Targa Communications. Today's discussion will focus on 2021 and will ask if it is time for the real estate market to panic. My name is Andrew Barber and I am Managing Director of Targa Communications in London. And as usual, as I don't speak any German, I must apologise in advance for any poor pronunciation. During the roundtable, we will be taking questions from the audience, and I would ask you to use the question and answer facility provided by Zoom. We will try to answer as many as possible over the next hour. 2020 has been a very difficult and challenging year for us all. The pandemic has seen national lockdowns and social distancing restrictions have impacted the way in which we work, shop and socialise. Infection rates and, tragically, death rates continue to increase. The arrival of vaccines is obviously tremendous news, and vaccination programmes are being rolled out around the world. In the UK, the first recipients received their inoculations yesterday, and it is expected that vaccinations will start in Germany in January. The numbers involved and the fact that the vaccines will not prevent transmission of the virus will mean that social distancing will remain a feature of our society for the foreseeable future, and the chaos caused by COVID-19 is set to affect the global economy well into next year. The pandemic has also made it necessary for everyone to adapt the way in which we interact with each other. The way we utilise the built environment and real estate has changed, and as a result, property markets have been impacted, with some sectors more vulnerable than others. With ongoing discussions regarding another total lockdown in Germany after Christmas, it seems that it will be a long time before normality returns to the property sector. However, COVID is not the only challenge facing us as we approach 2021. As always, geopolitics comes into play. As a Briton, I have to be the first this afternoon to mention Brexit. Even at this late stage, we still do not know what the UK's relationship with the EU will look like in 3 weeks' time. I can only apologise for our politicians. Across the Atlantic, early the new year, there will, or should be, a new president in the White House. Who knows what Mr. Trump might do before then, though. We wait to see how the new administration will impact international relations with China, Russia, Europe and the rest of the world. So what are the prospects for real estate investment in Germany for 2021? Will the new normal bring opportunities, or will it be a disaster for property investors, property managers and asset managers? In short, is it time to panic? To examine the prospects for 2021 and the opportunities that might present themselves, we have assembled a highly experienced panel of experts who, over the next 60 minutes, will be providing you with their considered thoughts on the subject. So let me introduce them to you. Firstly, we have Robert Christian Gierth, Executive Director and Partner of ASSIDUUS Development GmbH. The property business is focused on development funds and governed by ESG criteria. He has stepped in at short notice today as his colleague Alexander Happ is unfortunately unable to join us. And thank you very much for joining us at such short notice, Herr Gierth. Robert Christian was, until the end of 2019, in charge of the Berlin branch of Colliers International, which he established over a decade ago and which he developed into one of the leading service providers for commercial real estate in the capital. He is a member of the expert committee for property values in Berlin. Next, let me introduce Torsten Holstein of CR Investment Management. With 2 state qualifications in law, Torsten has over 20 years experience of the real estate industry and previously worked as a lawyer with Lehman Brothers and private equity firm Hannover Finance. He subsequently completed a management buyout of the Catella Corporate Finance Germany and created CR Investment Management GmbH in 2004. Finally, our next panellist is Teemo Sharma. Teemo recently joined Twain Towers GmbH as Managing Director, having been CEO of JLL Germany since 2012, where he was responsible for the strategic leadership of the business that had an annual turnover of several hundred million euros. Teemo previously worked for DTZ in Frankfurt and London and Atis Real in Germany and Paris. He is acknowledged as an innovator in the digitalisation of working methods within the property sector. I would now like to introduce our lead moderator today, Mr. Charles Kingston, who is CEO and publisher of eFire, the online publication about German real estate for international investors. eFire is focused exclusively on reporting about the German real estate market in the English language and was first published in January 2006. So without any further delay, I will ask the panelists to activate their cameras and microphones, and I will hand over to Charles Kingston to lead the discussion. Over to you, Charles.
Good afternoon, everybody, and you're all very welcome to this panel discussion. This is the last one in the series for this year between eFire and Targa Communications. There will be a fairly packed program next year as well, but we're very glad to have this discussion this afternoon. Some people may think that the title of the discussion spells doom and gloom. I think we're going to find out this afternoon that there may be different views on all of that. And I'm also very glad to say, with the combined experience that the three panelists have here, we will be able to look at this from a number of different angles, and I'm looking forward to doing that. So, without further ado, let me just start by perhaps throwing the question at all three of you very quickly, by means of allowing you to give a quick statement also, whether you think it is in fact time to panic or whether this is much ado about nothing. I'd like to start, perhaps Teemo, perhaps you might kick us off.
I happily can, thank you. No, I don't think it's time to panic. Obviously, the circumstances the markets in Germany operating in do not look good from every angle, but the numbers which came out spots a light on the latest evolutions here. So in some sectors, volumes came down heavily. Hotels, for example, more or less 50%, while others are still holding up overall around minus 20% investment volume, which is forecasted for 2020. And I think if you ask around the news and the personal experience of a COVID-19 incident felt worse than minus 20%.
Okay, so that's a fairly optimistic approach.
Whenever I'm optimistic, I look different. And no, but I mean, yes, it's a crisis, but no time to panic. Yeah, minus 20% is quite a hit, but not as bad as it could be. And who knows what next year brings? I mean, there's still some economic outcasts with effects on the real estate markets to be witnessed. But I think Germany once again, and I don't say this to advertise to my home country, but I think Germany once again stood in for the attribute of being a safe haven across the target countries in continental Europe, and rightly so if you look at the numbers.
Very good. Torsten, your company has been around a long time. You have a lot of experience on both up markets and down markets. In the past, you have said that you think there could be price corrections coming up. What's your view in the market?
I've been pretty steady in repeating over the course of the year that we hear cracks in the system. By that I mean the financing of real estate investments, and coming closer to year end, I must say I've predicted this to be felt already much more in the fourth quarter. I've always said we will feel it in the fourth quarter and beginning of next year. I still hold my view. I still believe that we will see a lot of change, this mainly on existing transactions already. So I've not looked at the transaction volumes like Teemo has done. I've more looked at already existing investments. And I believe that over there are some, if you look at all the market participants in the real estate market, there are some who have all reason to panic, and there are others who don't have a reason to panic. The people we often don't mention in these surveys are the tenants, and I think many tenants have a reason to panic, and also many landlords, let's say in the industrial sector, have reasons to feel uneasy, and all of them are somehow users and owners of real estate. And therefore, of course, if I look at the very established and core market segments, I don't see much panic right now, and we have seen a shift in transaction volume, a significant one, but we haven't seen a big shift in prices, both on the rent level and on the purchase prices. But in other parts of the market, if there are transactions, we see the impact already. And I think we'll come to that a bit later in our panel. So I believe what we're seeing and what we're facing will be a market that is more diverse than we had in the last 3-4 years. But for every market participant of the real estate market, that makes it more interesting, because there is movement in some parts of the market. It's steady in some other parts, and normally there is some arbitrage opportunities for people who operate in there. So I'm glad that I'm not a big tenant currently on many properties. I'm glad that I'm not an operator of a Congress hotel or an airport hotel, and I could name a few others who probably have a slightly more stressed view on today's topic than I have from my view, where we are a workout firm.
That's very interesting. I note that even today there was some sort of tension between statements put out between the Tenants Association and the TSIA as to who believes whether the landlords are saying that the number is much higher of tenants who are not paying, and the tenants are saying not at all, we're all paying, and there seems to be a discrepancy there. That's something we can look at as we go on. But the message there basically is that you think one has to look a lot more differentiated at the market and not come up with big sweeping statements. But we will be looking at the individual asset categories shortly. So I think we'll be able to tap into what you're seeing there a little more closely. Robert, what can you tell us? Are you an optimist, a pessimist? As a man who worked for 20 years with Colliers, you can only be an optimist, right?
Sure. There's no panic in the market, and there are no fire sales at the moment, especially for the developments, office developments. There are no fire sales, and I think that the market is still waiting what will happen in the next months. We don't know what will happen in the first quarter or the second quarter next year, because we don't know how long will the pandemic going forward. And so at the moment, many people are waiting for what will coming in the next months. And so not so many transactions in the market now. But this transaction, what I know, are not lower than before. They are the same level. Maybe not so many bids at the moment for the projects. But the market is at the moment ongoing. The business is good. What the problem is at the moment is the financing, because developments especially are very difficult to get the financing in the moment. So you need more equity. That's normal in a crisis like this, but it will be changed hopefully in the next months.
I think
you invited us all to have a lively discussion. Can I jump in here?
Yeah, of course.
Thank you.
Please.
Because we heard some arguments that we should consider panic looking at the tenants.
Yes.
Obviously, if you pick some prominent sectors and examples, that might well be true. But if you look at the sheer facts, the IFO Institute, as well as the German Kreditreform, so one of the credit and solvency ranking agencies, or probably the one in Germany, they just published their latest numbers. And as you can see there, the level of insolvencies has gone down compared to previous years and years averages, as well as the companies' fear, let's say, of upcoming insolvency has come down as well. So both insolvencies happened 2020 and fear of upcoming ones. I think this shows how well, in quotation marks, the governmental protection plans did work. I know that not all the funds have been pulled, which have been allocated to help stressed tenants and sectors. That's a different story, but at least it exists. It has been triggered partly, and it shows the effect the wider economy needs to stabilize such stressed businesses, and hence the tendencies of the landlords which we are looking at. So Again, I think if we blend out emotions and look at some of the sheer numbers, we should consider that positive effect as well.
I've seen yesterday in the news the same figures on insolvencies and on unemployment figures that you are just referring to, and actually it made me smile because it is an untrue picture of reality, as in my view, as it just shows that we will have a big wave of things which are pushed into next year. And I agree that so far the measures have worked very well, but also in the meantime, our some people in our political business have realized that we cannot go on forever with these measures. And I can only tell you that the insolvency practices are all gearing up and hiring because they see this as a push of companies into the next year when lots of activity will come. So I'm also not criticizing that. I find it good that the companies had the possibility to buy some time and maybe to restructure and avoid the biggest impacts of the situation. But there will be an end to the help that can be granted to them. And then we will see, of course, companies collapsing. And let me put this, when those who remember the financial crisis and who are around now will see that it's a very, very different crisis. In the financial crisis, we had stress in the financing systems, but the people who pay the party, the tenants, were still there, and there was rental cash flow. And today, in those cases where we will see insolvencies, we will see that there is no rental cash flow and no cash flow for the financings as well anymore. That makes it more difficult to handle than the financial crisis. And I think it makes it more difficult to predict the knock-on effects. So if someone falls over, whom will he infect, and where will the next effect of that will come up? I think that was much easier to predict and therefore to deal with in the financial crisis compared to today. So again, I say it makes it more interesting.
Well, that sounds like what we're looking at is a sheer inability to find accurate visibility in pricing. We don't really know in many instances until companies take radical moves whether they're how well they're doing is effectively what you're saying, Torsten.
Now, let me jump in. I'm not saying everything will get cheaper. Quite the opposite. I think good quality product which will be requalified now, will appreciate in price due to market functions in terms of the amount of money available, the need to invest in a pretty stable environment, as Teemo had outlined before. So some product will increase in price and other product will of course decrease in price. And as long as you don't need to realize it, you will not do it. And I think that captures also what Robert has been saying. If you don't need to, you don't do any fire sales right now, you don't realize this and you hope to push it somewhere out. But there will be a repricing and a different pricing of risk in the future. And I always come back to it. That is actually something which is a more normalization towards a state which we had in the last 2 years, certainly, where almost everything got priced pretty the same way.
I'm with Torsten, and that's also fueled by the banks who are pushing on the core side. So LTVs are rising, margins are coming down. You do have competition from debt funds, mezzanine funds, and other capital sources. And at the same time, on the value add and optimistic side of the business, and I think this is what Torsten meant when he said, let's revalue what value is and what core is, you see different pictures. Banks are shying away. They are lowering the LTV levels. They start to build up distressed units, as well as the companies which Torsten just mentioned. So yeah, I agree to that. I think this is a division of the market which is surely coming soon.
Well, Teemo, we'll get back to that because I think that's a very key point. Perhaps you're talking there essentially about expectations based upon perhaps previous models of yield expectations, which may or may not be realistic for the next couple of years. And what Torsten was saying, I think, is interesting because, well, it's good that we have a developer here amongst us, because while those who are holding Bestandsobjekte, whether it be in any asset category, they're not necessarily forced, as long as the banks aren't forcing them to take drastic action straight away, as long as they can still trade. But developers, of course, and Robert will be telling us more about this, developers are faced with a new situation, that they are up against banks who may be deciding to pull down the shutters and are scrutinizing all developments far closer than they were in the past. If I could, for all of us, if we could just have a very brief sweep across the main asset classes. I don't want to get involved in too long a discussion about, whether we're all going to be working from home or not, because I think that's been kind of trashed out to death in hundreds of discussions. And it is, we do know that of the main asset classes, it is the one big question that is hanging over the industry. What will happen to offices? But let's just have a brief look at offices in a handful of quick sort of decision points about offices. Are you optimistic? Where do you see trouble? And then we'll have a look at retail, logistics, hotels, and residential, just briefly, so that we cover the main asset classes. Teemo, just fire us off there.
Okay, so let's start with office then.
Just on office right now.
Letting volumes came down approximately 30% this year.
Yeah,
so that's quite a bit. It's normal, I have to say. Yeah, in a crisis, and even a mild crisis, as long as the decisions are postponed. And I'm speaking about postponed only, not taken off the table for good. That you feel quickly on the leasing side with a time lag. Looking back into previous crisis, time lags were often around 3 quarters, so we are not completely there yet. Looking at Corona, but up to now it's minus 30%. On the other side, if you look at wider economic numbers and the future employment need of companies registered for next year, that's good for 1 million plus square meters of offices as take up. So if we are man enough, let's say, to learn from past crises and do accept the global financial crisis as some kind of role model, you will see that the gross domestic product bounced back super quick. It bounced back within a year. It landed on levels which were higher than the levels prior to the crisis year itself. So I agree, we all don't know how long the vaccination programs will take and all that. But I think we can more or less rely on the fact that the gross domestic product will bounce back quickly, maybe within a year, like it did after the financial crisis.
Okay, so your key point there is that with a time lag of about 3 quarters, and the figures coming out of Germany are actually quite optimistic about production and manufacturing, that time lag seeps into the real estate industry and reflects itself in strong office take up about 3 quarters later. Yeah.
First, the low take up, now year to date minus 30%, but that's only 2 full quarters of Corona, right? So yes. 4th quarter still to come. That would then complete my 3 quarters of time lag, and probably the low point, let's see, with the potential of a bounce back fueled by gross domestic product increase next year, if we are lucky, and things turn quickly like they did in the global financial crisis.
Good. Robert, you know the office market also very well. What are your views on it?
I agree with Teemo. I think that the tenants are still waiting what will happen in the next months, because the calculation, their budget, they don't know what will happen in the next months. And but our feeling is that they are asked for better products. If the tenant looks on the market, he sees a lot of old buildings without any air, especially filtering for virus or whatever. So they are looking for better buildings, with a very good air condition, with more spacey rooms, with bigger rooms, to sit the people a little bit wider than before. And there are not so many products like this on the market. So our feeling is that the market will split. Older buildings will getting maybe a problem in the next time to find new tenants, and newer modern buildings will be getting easier to find good tenants.
Good. Torsten, this coincides with your view of differentiation, actually, doesn't it? That A stock will win out over B stock.
Absolutely, and it's always good to be the last to be asked the question. So you a lot said already. My first part of the answer is I'm sitting in the office, so I don't think to come to your point that we will all not be coming to offices anymore. And I think just as Robert said, first of all, in an international comparison, when we read international publications and hear something about the need of change in offices. In Germany, we have had already historically, let's say, a bigger footprint per person, per employee in his office, and we were closer to windows and light, daylight, etc. Everything that has an impact in this time than in some other countries. So we are starting from a better point if you look at the international publications. And then I believe what Robert said is absolutely right. People will look, and for many factors, they will look at better quality stock. I'm also quoting in that context the European taxonomy tree, where at least institutional holders of office stock will have to look at the type of buildings which they have in order to fulfill their targets there. So I'm not worried about new good office property. They will find their tenants. As usual, there are always some peaks where maybe you'll see top rents going down because there has been a peak in demand, but nothing dramatic. And for good quality stuff, absolutely no fear that they will come into problems.
Sorry, to cut across here, we've got a few questions coming in which relate to occupiers. A couple of questions from Theo Suter, who was a speaker at our Real Estate Investment Day in September. He wants to know, what about all the figures around zombie companies that we will not be able to keep alive, and asks, or states the level of insolvencies is delayed. Sorry, that's Marcus Caruta's question. Levels of insolvencies delayed, giving allowance for not filing. And Theo asked, to what extent have insolvencies only come down because of government support?
I think we've covered all of them, haven't we?
Is there anything else you wanted
to? Pretty much, yeah. For the moment, let's move on. We can hold those. We can hold those also, Andrew, if you want, to the end, if they're still haven't been covered.
Sure.
One of the asset classes that has seen a big inflow of funding in the period of COVID, which was already happening anyway, is the area of logistics. Torsten, there's an awful lot of money going into logistics. We all know the arguments: e-commerce, last mile, nearshoring, onshoring. Are there dangers of this shift in allocation to an asset class that?
Let's say there's always a danger if you see too many people rushing into one flavor of the month topic. And then I believe with logistics, it's probably one of the fields where I'm the least expert. I believe the expression covers a very, very wide range of products, and some part of it others would call light industrial or so. So it's from sheds to really highly technical installations. I believe only a part of that market will benefit, a part will really grow, and others will have a price increase for a while until the market figures out that it's actually not the logistics that will benefit from the current situation. So I have a pretty agnostic view on that, and I'm sure there are experts for that field who can comment better on it.
Teemo, you know that segment also quite well. Do you think there's an overpreponderance, an overweighting going into logistics at the moment?
Overweighting measured against what? My counter question would be. I think it's a natural reflex, what we're witnessing here. And you got new players and new funds pushing in with strategies they call beds and sheds, because those are the two asset classes. So beds in the residential, but not only residential, can also be health, elderly living, and you name it, which is then subsidized under the beds argument. And sheds as obviously logistics and industrial. So those two are the obvious winners for now amongst the asset classes and where we stand in the crisis. And both had a run before. And I believe that what we are experiencing here is Corona being an accelerator in very different contexts. Yeah, you mentioned remote working, digitalization, and other themes which are obvious, but also trends when it comes to real estate investment allocation. And beds and sheds are profiting. I don't see, however, a bubble building up in the logistics field. If you look back in the duration of the yield compression logistics had experienced on German territory, it goes long back, many years, and over that time still with a big difference compared to prime yields in the UK, especially in the US. So also that gap amongst prime yields comparing different countries and legislations is a driver which is now accelerated and strengthened by what's happening out there.
And much of this new inflow of funds has also been diverted from other asset categories, such as the retail segment, apart from non-food or food anchored, I should say, which has been doing well, and hotels and hospitality. Robert, those two asset categories, is there light at the end of the tunnel in the immediate 2021, 22?
Yes, maybe yes. This category, the asset class, stopped at the moment totally. So most people are still waiting what will happen. My feeling is that the old hotels have very big problems, and they're better. The new hotel located directly in the city, they had not so big problems. They will be waiting what and hoped that the market start again in the next half of the year and coming back. But there are also no sales on the market. We are looking as a developer on this market very intensive, because we hope that we get some hotels for new development for like an office, for office building, but this don't happen at the moment.
And many of the big hotel groups like Premier Inns and so on have out and out been saying we're holding our powder dry to profit from the weaker competitors in the market once we can. But we're not actually seeing that yet, are we?
I don't know it exactly, but I think at the moment there, I don't know, maybe Teemo has more information about this. We are not so deep in the market for the asset class in hotels.
And maybe Torsten sees a whole pile of competitors lining up in the wings, licking their chops and anticipating a feed in the future. Huh? Let's talk briefly about financing. And I know that for you, Robert, this is the toughest area to be in at the moment. People looking at projects that are due to come on stream in a year, 2 years' time. This is where the banks are showing maximum nervousness. But also the various barometers that we have in Germany are showing the financing climate at pretty much all-time lows. The banks are exposed, not to the same extent that they were after the 2008 crisis. I think they've probably got better NPL asset quality that they're looking at, and some of the foreign banks are actually coming back in to the market looking for opportunities. Torsten, can you tell us what you're seeing about on the financing front? We're obviously experiencing non-traditional lending rising, and others looking at the market. What do you see?
I think we need to look back a bit. We've quoted a couple of times the financial crisis, and I think what we've seen post the financial crisis has been that the banks have been more I don't know whether disciplined is the right word. At least they've stayed at lower LTVs. I think they've done their underwriting also before very well, but they've been just more stretched. So the banks have traditionally stayed in these last years at lower LTV exposures in general. And the gap had to be filled, and the gap has been filled in many instances by newly set up and some traditional alternative lenders, insurance companies, and debt funds in the form of mezzanine funds, whole loan funds, etc. So in the current situation, I would say if you look at who comes under stress, it will in many cases not be the bank first, but someone who has been filling up the gap between the equity and the restrained LTV level of a bank. And when you ask about the current situation, how banks are responding, let me put it that way, where I have recent experience in the hospitality sector. Of course, in all models, exit multipliers are to be taken down considerably. And of course, the LTV also goes south. To give you a feeling, probably a 50% LTV is for hotel development today. I would say probably a very good result if you achieve that. And when multipliers had been in excess of 20 in the last years, it definitely has to have a 1 in the front and probably 17, 18, something like that in the model. And if then it works, you can still continue. And I don't have the experience right now in retail where it's probably more diverse, because we've seen Fachmarktzentren have held up very well during the year. So the situation there will be different. And for neighborhoods, grocery shops, it will be probably best currently, whilst different to some larger shopping centers, which sees currently opportunistic buyers who come up anyway already with a larger equity portion plus some meds. So you see, it is diverse, and I think, as I said, the landscape is such that it is interesting right now.
Well, that sounds to me like you're expecting some players to really suffer, actually, perhaps a lot more than we've experienced. I mean, I know you've been bearish on the primary, on the luxury segment in the past.
I've been bearish on the luxury segment in the high street retail, because we see that over the course of this year, many of the luxury companies have established a strong online presence. We've just seen that Richemont, I think, I'm not sure whether it's Alibaba or Tencent, and Kering together have decided to spend over $1 billion for a new luxury platform, which Richemont puts in its Yoox and Net-a-Porter platform already. So they will also give for luxury such a push. If my latest market information from Frankfurt Goethestraße currently is 80% down in sales, this is luxury. So this is pretty dramatic. Will they come back to the same levels? What has been driving it? Many travel. So many people have been traveling from Asia, from the Arab world, from Russia, have bought in there. They cannot do it at the moment. Will the forecast be that it all comes back to normal pre-crisis when they can? I predict no, but it's not bad, because when I look at the development of these rents over the last years, I very well remember when Goethestraße was not 400 and something per square meter rent for a shop, but let's say 100. And that has been going up also without much to do by the landlords over the time. If there's a little bit of correction, that's not the end of the world.
Well, many of us remember when office rents in Frankfurt were the equivalent of 50 Deutschmarks, 50 euros, 100 Deutschmarks 20 years ago, and they never regained that level again. Teemo, is what Torsten saying imaginable, that in fact the entire rating of the retail sector could be smashed for years to come? The big airlines are obviously taking the view they don't need the capacity for the next 4 or 5 years to fly these people all around the world.
True, might be a true indicator here. If such high spenders are not flown in, I think some of the luxury miles will have issues, yes. One thought I had earlier when Torsten was speaking, it's easy to say the new normal, or come back to the normal level of pre-crisis. Who tells us that 19 was a normal level? Maybe it was a bit inflated. Maybe money was too loose on the consumer's side, as well as looking at rental growth. So if you look at corrections, and those corrections are somewhere, I don't know, 10% here, 20% there, for me, that's not panic. These are normal cyclistic corrections here and there, which bring down the overall growth levels. It can be a short dip, it can be a mid to long-term trend. but I think the overall quantum is natural and not to worry. I do believe that, I said that earlier in a different context, Corona is an accelerator. And retail being in trouble is not news of 2020 and Corona. Many retail sectors, many high street areas, many concepts, many groups of goods, let's say, in the high street were in trouble before, were pushed around by e-commerce, by experience concepts, by new gastronomy concepts pushing in and facilitating growth in sales numbers, while others couldn't benefit from that trend. And I think what we see here is a little bit surviving of the fittest, but not only caused by Corona, but accelerated by it.
Let me add on to that, please, because this is something in the financial crisis. We took over a lot of retail assets as asset managers, or by buying. Why? Because of course they were the most highly levered. Then we had the insolvencies like the Herties, which we all sold. And we had the experience then already that only the same 1, 2, 3 tenants were the people on which every buyer built their financing and their acquisition. And by selling it, which was our task, we thought already this can't go well if in every large town, medium-sized town, small town, you have the same Filialisten looking all the same. And we were predicting that this, whilst the whole, as you say, the whole conversation about the growth of e-commerce was ongoing then already, we were predicting that this would come to an end. And is it bad? No, it's, as you say, the normal change of an industry. It has grown tremendously. The shopping areas have expanded tremendously, and now they will go back a bit. And people have, if I take a very sarcastic look, people have also become wealthy by just owning a space which all of a sudden was of appeal to someone who rolled out his concept. They didn't do much to gain this additional wealth, and now it's going away a bit. So it's, for me, again, like you say, that's normal developments and nothing to panic.
Well, one of the big themes, of course, whether it's COVID or what was happening anyway, is mobility. Mobility generally is having a big effect on valuations, or will have a big effect on valuations in real estate once people are going to have to work a lot harder to get their concepts together. For example, Teemo, I know this is an issue that you've been interested in. What sort of new fields do you think can this throw up opportunities for people, for businesses, as a result of not just the fact that we can work at home, but the whole digitalization of industry? I know you're involved in the prop tech as well yourself, but this is surely playing a big role in what is likely to be the success or failure of real estate property and individual properties in the long term.
Mm-hmm. Let me give you 2 answers to that, one targeting in prop tech and the other one at infrastructure, and I do start with prop tech. If you look at that scene, and I'm based on Berlin, and the prop tech scene here is pretty strong, you can sense, see and feel on every corner of the city that the field is really divided. On the one hand, throughout the crisis, what's the normal reaction of bigger institutions and larger blue chip companies, which are all forced now to think about digitalization much more than last year? They look at the costs, and they might hold back investment decisions. And such decisions which come along with the need for digitalization or investment in prop tech or self-development of such solutions is pricey. So you do see a lot of cases where such decisions are postponed and pushed forward into the near future. So equity is an issue for a lot of those companies. Equity raising has been easier prior to the crisis, for sure. On the other hand, I said it's divided in 2 fields. On the other hand, you have a lot of tools, a lot of offerings, a lot of digital services whose concepts are now proven to function, with a lot of help and a lot of wind in the sails by the crisis and by this massive push into mobilization, remote working, digitalization, and you name it. So they're winners. on the operating side and on the view of individual concepts, but also on the institutional side. So if you look at PropTech One, for example, which is the venture capital fund in Germany going into PropTech, they were able to well benefit with plenty of their portfolio companies. So let's see, but I think there will be a lot of winners as well. Infrastructure and mobility. Yeah, I think here there again were a lot of trends to make us rethink our mobility, to make us rethink the value of infrastructure anchored properties and real estate. ESG is pushing hard, obviously, carbon footprint, put pressure on private and corporate travel, but nothing compared to what we have now. And I think that here the companies will try to benefit on the way forward from that experience. It has been proven that not every meeting needs to be physical. You can bring down hotel nights, you can bring down flight or other travel miles, and they will save costs, I'm sure, and will push for that. And this will have effects on infrastructure-related properties. Someone mentioned earlier airport hotels, that's one, but you also see interesting concept, hotels offering their rooms to office workers who didn't have the home office place to work from home, and other concepts. So again, I think overall the effect here is often negative, since mobility came down and the pattern of our mobility streams is shaken. But there are some clever concepts to benefit.
You mentioned ESG. This seems to me to be, although people are vaguely aware of it, Robert, I think many people are completely underestimating what's coming down the turnpike at us in the next few months, aren't they?
Yes, you're right. I think the people are now more thinking about what is our future, how will our future looks, and so they are talking about to go more green, like the Green Deal. We talked about the EU taxonomy before, and ESG is a very...
And Torsten mentioned this EU taxonomy. That's coming into play in March of next year, right?
Yes.
In other words, this is going to be the third pillar, along with return, risk, and now sustainability is not a nice to have, but a must have for future investment.
Yeah, Charles, you're right. It's a must have. And the investors are looking for products like this, and it's very difficult to get products. They are green, they are social, and they have good governance. But it's very difficult to find products like this. We are, as a developer, are specialized on these products because we think this is the future. And also it's much more easier to get the financing for ESG product, because people are asking for products on the bank account and on the bank account, and want to sign a product like this ESG criteria. And we have to talk about the mobility concept in our developments. We have to talk about our green concept, our zero carbon concept. We have to talk about a social concept. What can we do for the neighborhood? What can we do for special tenants with there's not so much money in the pocket, and for companies who will grow up and they give them space. So that's very important, and it's important to talk about the ESG criteria very intensive, and to find new ways for this kind of products.
I mean, it seems to me that Germany has always been strong on the E side of that, and perhaps the G, but the S factor is becoming the one that is throwing the cat among the pigeons, isn't it? When anyone who either invests or who finances has to be doubly, triply sure that they're not getting involved with something which could blow up in their face.
Yes, Charles, that's right. The S factor is for the most people a big question. What is S? What does social mean? In our opinion, social means some differences. It's the health. The health is very important for the tenants in the buildings. to make a product very healthy, with all the air conditions and so on. And also what I talked about before is to find tenants that they have to bring back something for the neighborhood, to find companies that they have a place for new ideas, and to work together with all the neighborhood, to work together with some social projects. And but typical, all the developers say, okay, when I have to find tenants with not so much money in the pocket, it's not so good for my project, not so good for my multiplier and so on. And so they don't want to do this maybe. But I have.
But they may not. They won't have a choice from next year. It is going to be law, isn't it? It will affect the funds. It will affect investors.
Yeah, it's a moment. Charles. It's a moment. It's only for the E. That tax EU taxonomy. It's only for the E. For the environment, only for the green aspect. They are looking for zero carbon developments and buildings. That's much more easier for the most people to create a development like this. But it's not easy to create the social aspect because it's a moment it's not really defined. There are not so many criteria for this. And so we have to work on this aspect.
Torsten, Teemo, will this remain a soft field for a number of years, or are we looking at hard measures? I know certain American investors and fund managers have issued strict diktats that unless their representatives and whoever they're working with out in the field is not operating 100% to these principles, they're going to be sacked by the end of next year. How realistic is that? Are we behind the curve in Germany, or are we? Is it again creating a lot of waves about something which is happening anyway?
I would agree to what just has been said, that the S element is for now in Germany the weakest one so far, the weakest one to measure as well. E, I think we're not far behind for curve, and G, same picture. I mean, they are very mature operations and bodies operating. Think of the ICG, the Institute of Corporate Governance in Germany, which has just welcomed the 100th company membership earlier this week. So you can see that there's a good understanding, a good push into that part of corporate responsibility in the form of governance towards shareholders, towards clients, and towards other touching points throughout the operational doing. The S factor, how to measure, let's see what develops there. And I think you also have a different angle to it. I mean, governance is everywhere. The E is everywhere. The S is not easily reflected and measured in every asset class. If you say, okay, let's break it down to properties with social impact or with tenancies which are in that field, think of schooling, kindergarten, elderly living maybe, then that asset class in total is a rather smallish part of the overall investment market in Germany. Hence, the angle you can give to it by pure weight will be a little bit harder to lift and more difficult to find than, for example, deciding to build offices which tick the green box.
I believe all of this is true, what has been said, but it's mostly relevant for everything new. And if I make, again, the jump back to financial crisis, we've often been asked on panels if it wouldn't be great if we offered some green aspects in the buildings. And the standard answer of workout asset managers then was, no one pays a cent more for a property like that. 10 years later now, as we heard, it's mandatory for some part and a big part in the meantime of the market. So this question doesn't come anymore, and everyone who builds something new is bound by this. And I agree, the S is not measurable currently like the others are. But coming back to what I said earlier, for those who come into trouble now, only if you do a total repositioning of the buildings, you will incorporate that, and otherwise you're fighting with no rental income, very little rental income, and you cannot fully comply with that. But for everything new, I think we're right here, and more institutions will make it mandatory to do so. And Charles, I'm not sure how in the US the S is really measured. I've had various conversations with the likes of BlackRock, etc., who have very strict guidelines, but I haven't seen really something compelling in that field.
Right.
Charles, we have a few questions.
Sure, Andrew, yeah.
Time is pushing on. Although less of a question, more of an observation by Stefan Scheier that 50% of existing office properties were built before 1979, meaning that sustainability requirements could be difficult to realise. So echoing what you said there.
Wait, now, let's maybe get a quick response to that, Andrew, if anyone's got anything to say. I mean, we do know that the life of a modern office building in Germany these days is about 20 years, isn't it? Before it more or less has to be gutted and refurbished.
Yeah, but if I might answer, I think Stefan is right. I mean, with 50% being 40 years plus old, obviously that's part of the purpose. These measurements and political decisions are not targeting only at newly built properties in the future, but also want to push sustainability measurements in the existing stock and give that a go and make it a must-have.
Okay, Torsten?
I agree. Nothing to add.
Yeah, good. Andrew?
Going back to retail for a moment, that the observation is that looking at the Zeal shopping street in Frankfurt, the big players leaving.
The tile, yeah.
Yeah, what are the prospects for high street properties? And isn't it time to panic? I know we discussed the luxury sector at length, but there are other less luxurious retailers who are moving on. And that question is it time to panic from that point of view?
Well, if there's any example, just down the road from our office here in Berlin is the Forum Steglitz, which has for the last year and a half been gutting its top 2 floors and turning them into offices and co-working centers and so on. And it's going to be opening up sometime in the new year with a whole new range of shops and so on. So some of the big centers are already, I mean, they're very aware of this, surely, that this is the fate that awaits many of them.
Yeah, I think we will see a change in these high streets. Obviously, Zeil is really a high street and not luxury. And Teemo said it. Corona is in that respect accelerating things and putting a focus on developments which we saw already a long time ago. I think there's probably not a single week in which not someone who's a retail tenant goes bankrupt, regardless of the low figures which are quoted. If you see the figures of outlets which they have, it's always a couple of hundred. So it has a big impact. But when you look at high streets and also on luxury streets, you see these are streets which are in a constant makeover. It's part of their lifeblood, and whether it's time to panic, it depends on in which role you're involved. When you're looking at it as a user, you can say, all right, it might be not so interesting at the moment, so you don't go often, and then after a while you see that they have reinvented themselves.
Handel is Wandel, as they say, yeah? Permanent change. Other questions, Andrew?
Yeah, Label Vincent says that Europe tends to follow the US with a time lag, and that US price trends have seen office lose 10% and hotel and retail losing 20%. And he says, is that panic, and will Europe follow?
I think we covered it partly. Yes, time lag-wise, I think things will follow in Europe. And yeah, the 10 and 20% quoted here, I think we mentioned earlier, or at least I said that a correction of 10 to 20% for me is no crash and no reason to panic. Maybe it's the beginning of a crash, let's see. But for now, it's a correction which is within healthy measures and no reason to panic at all.
Okay. And Fernando Salazar asks whether we could be precise about which asset classes banks are abandoning development finance for. Going back to the early part of the discussion.
Robert, that's up to you.
At the moment,
everything you don't do.
That's, yeah. Tell us you're in the right asset category, Robert.
Sure, absolutely. It's the moment right asset class. Yeah, sure. Like Teemo told before, I think it's a big problem at the moment for hotels and also retail. And maybe logistic is interesting for the bank financing, but office at the moment, I think it's the best what you can do. But I have a different view on the markets. They say, okay, only the really core products are interesting for developments. If you go outside, a little bit outside of the center, and you have not really a core location, it's not easy to find. If you go to maybe to Schönefeld, this is very close to the new airport. The new airport in Berlin, you know, he's now open. This is really difficult to get the financing for office building like in this area.
But Andrew, you did mention something there, Andrew, about a time lag between the United States and Europe. One thing we've seen in the past where that time lag has actually materialized is in the area of data centers, which has turned out to be a big growth area, with Frankfurt being pretty much at the center of the action. Teemo, do you know this segment quite well? It's a specialist area, but it's
a very small one.
It's been booming.
It's both is correct. It is booming, but it is small. And again, for me, that's a continuation of a trend which we saw prior to Corona, now fueled by Corona. I believe that you will have some of those traditionally alternative asset classes, let's say, which will move up on the shopping lists of international investors. And data centers, server farms, you name it, are definitely a very prominent example, maybe the most prominent example. I also think that some of the subsectors in health will definitely benefit from what is happening at the moment. But yeah, data centers, and especially Frankfurt, it has been the hub, at least in Germany, and potentially for continental Europe before, and has now been strengthened.
In the so-called life sciences, which is, I think, what you're referring to there, there's been colossal growth now in the United States, particularly around clusters, around San Francisco and San Diego and Boston. And there are signs that this could be a very strong area. Germany is particularly strong in this whole area. I mean, of course, the British are celebrating being the first people to give the vaccine, but it's a German invention essentially, which they're using. And Germany is like third biggest market or country in the world for biosciences, with some seriously heavyweight German companies there. Now, one of the big problems in the past few years has been enabling a critical mass of startups to go out on their own rather than attaching themselves to the universities or to publicly financed real estate clusters, I suppose, like Adlershof or in Halle or Heidelberg, or which of course makes it difficult for the inventors among the bioscientists to truly feel free to set up their own business independent of the company or the university which sponsors them. And what we've seen in America is the rise of this so-called prop sci, as they call it, or life sciences independent building of real estate as a profitable new asset class. How How would you rate that in Germany? Is that something that within the next 2 to 3 years could become a realistic new asset class for investors? And Torsten, I'd be interested to hear your views as well.
Yeah, I think that's interesting because already 10 years ago, it with some international institutional investors, it was an asset class which has been started, but it didn't get a broad prominence. That has increased already over the last 2 years, I would say. But in the peculiarity in Germany versus, let's say, what you're quoting from the UK is that we have quite a few, again, of medical, life science, etc. centers. We have Medical Valley around Nuremberg, Erlangen. We have something equivalent in the north. We have the Heidelberg area, which was more biotech, etc. You have, if you think of it in the UK, it's mainly the cluster around Cambridge, which has grown tremendously over the past 20, 25 years. We had Martins Ried outside of Munich. So we have this in the true federal way in many locations in Germany. It has not been so far an institutional investment product, mainly because if you don't go already only into the established companies, you need to have an understanding of the likelihood of these companies succeeding and being able to raise more money and pay their rents. And so therefore it has been more locally dealt with than on a federal or international level. I expect this to grow. I expect more expertise to come in those fields also into the real estate sector. And I think this is one of the areas which will grow in importance again.
And where Germany has a competitive advantage.
Yes, and fired up by Corona. And my example, let's say, if you put it into the big world of investment product, if, let's say, a few months ago you had an office building which was leased to one of the office headquarters or regional headquarters of a big hotel company and the other one to a pharmaceutical company, they were valued the same way. This will have changed now. And that's part of the beauty of the real estate market. And this is, of course, something that will also bring investors into these more regional areas where you see life sciences, medtech, and all these sectors.
Teemo?
Just one thing to add. I think that Berlin, and I'm not saying this because it's my new hometown, but I think Berlin is especially going to be able to benefit from that. Why? Because even prior to the crisis, health as well as education-orientated tenants pushed up their take-up here heavily. And obviously that's a symbiosis you need within life science, technology and environments and companies. So yeah, I agree. I think we will see it in the established regions and pockets and in our capital.
Is that because we lead such a healthy lifestyle in Berlin, or because we need...
I don't know. I haven't been outside since 6 months.
I think you're onto something there, Torsten. And Robert, this can only be good for your business as well, presumably, yeah? If people start to see Berlin as having all those characteristics that make it a natural home for these kind of businesses.
Yes, life science is very important for Berlin. It's like many years a big market in Berlin. But also what's very important for Berlin is Tesla. Tesla, Elon Musk, if you read the last interview with him, together with Matthias Dörfel von the Welt, it was very interesting. He really liked Berlin, and he say Berlin is not...
He likes the nightclubs. He likes the nightclubs, I think.
Nightclubs also, and he say a very good place for business. And he will produce new products for Germany and also for Europe in Berlin. And thinks this is a really good message for Berlin, and we need these measures because
he's bringing a lot of jobs. He's bringing a lot of jobs, also highly qualified jobs of automotive engineers and so on from Stuttgart area up to Berlin as well. So that's a good news story. At least it is for the moment. Unless you're a nature lover and you're locking yourself to those trees that he's hacking down. But they're moving ahead at an incredibly rapid pace. I'm getting the message though from all three of you that you're far from pessimistic about the Jahresübergang to 2021. And of course, it is good news to have the vaccine. And once that starts kicking in, people are already talking about summer holidays for next year and so on. So anything else that any of you would like to add? Andrew, is there any other final question there that you might add to our understanding?
Yeah, we had a final question from Harry de Costa, who says how a data center is going to be able to meet environmental standards, which is a good question.
Whoa, that sounds like a whole session in its own right. I think we'll put that off for another day.
We do have a roundtable early next year on niche markets, and data centers will be one of those niche markets we'll be talking about. So I'm sure we'll be able to answer that question then, Harry, if you can wait that long. But no other questions at the moment, Charles.
Gentlemen?
Yeah.
I think you've put a spring in our step as we head towards Christmas and look at the next year. I'm glad to see that the title of this session was nowhere near what you all think it's going to be, and I'm inclined to agree with you. I think it's there's light at the end of the tunnel, and I think as Torsten said earlier on, it really is a question of differentiating within all asset categories, and I think people are going to be working harder for their real estate money as we go forward, because there won't be any easy money in real estate earned over the next couple of years. I'm pretty certain about that. Gentlemen, thank you all very much indeed. I think it was a very interesting, good panel discussion, and I hope we see you all again soon. And thank you all to the audience as well for listening in. I think we had a very big turnout actually today, and I hope you all learned something, gained some useful insights. Thank you again, all three of you. Andrew, thank you very much indeed.
Well, thank you, Charles.
Good night, everybody.
And thank you for everyone for attending. And we look forward to seeing you next year. Have a good Christmas.